Hello and welcome to TP Talks, PwC's Global Transfer Pricing podcast series, where we focus on key transfer pricing developments around the world. I'm David Ernick, a transfer pricing principal in PwC's U.S. Washington National Tax Services practice. Joining me today, I've got Stephan Rasch, a transfer pricing partner with PwC Germany, who's also part of our leadership team for our controversy and dispute resolutions network practice at PwC. Stephan is also an honorary professor for tax law at the University of Augsburg. And I'm also happy to be joined today by Michael Shaw, a transfer pricing and tax disputes director with PwC UK. And a little bit of background on Michael. Before joining PwC, he was a senior civil servant in HMRC in the UK, specializing in dispute resolution, transfer pricing, and international tax. Thank you, Stephan and Michael, for joining me. And more particularly, the discussion we'll have today will be about transfer pricing controversy, focusing in particular on the EU and the UK. And much like here in America, transfer pricing controversy is also frequently in the news in the EU and UK. And today we're going to be focusing on the audit environment, APAs, litigation trends, and more. Let's get started. And for my first question, I'd like to hear from both of you with respect to audits in the EU and the UK. And in particular, what are the tax authorities focusing on from a transfer pricing perspective in the EU and UK? And for our clients and taxpayers, what can they anticipate going forward in the next few years? Stephan, let me start with you, please.
Yeah, David, thanks a lot for having me on this episode today. Very happy to be here. And I think there quite some developments going on in Europe and in Germany. And I think we all know the DEMPI concept that has been introduced in the OECD guidelines and has been discussed, I think, for 7 years, more or less now. But what we see in terms of audit traction, that the DEMPI concept gets some audit traction is, and I'm just looking at Germany, but also for other European countries, we see a trend that authorities start using the DEMPI concept in order to come up with income corrections that go back, 5, 6, 7 years in the audit period. The problem, though, we have is the DEMPI concept. Yes, it has been introduced with the OECD 7 years ago in the very first stage and has been developing over the years. But nowadays, for example, like in Germany, we only have it in our law. So we only have a legal basis to apply the DEMPI concept for a year. And it is actually, we can only apply it for all fiscal or tax years starting in 2022. So if a tax auditor comes in and says, yeah, we think the DEMPI concept is the right thing to apply, and applies it for years like 16, 17, or 18, then obviously we're running into problems in defending these kind of income adjustments, because the taxpayer obviously has good reasons to argue, look, we all knew about DEMPI concept at that point of time, but there was a huge discussion going on at the OECD level with different countries. And only nowadays it's getting into the law. So if a tax auditor wants to apply it, that is all fine, but he should wait for those years where we have a legal basis to do so. And that is not only valid for Germany, it is also in a number of other countries. But let me come to a couple of other points. There are some classical topics like losses of distribution entities. I think we all know this kind of issue for decades, more or less to say. But it is still obviously a thing. Obviously, taxpayers are struggling to get everything on board, to have the right timing to get out of the losses with their distribution entities for some very good reasons. Take, for example, the pharma industry, where you see situations that even distribution entities have to suffer from losses for like 7, 8, 9 years. And if you then see tax authorities coming in, again, like the German authority, but like the Dutch authority, like numerous other authorities all over Europe, starting to say, look, you can only make losses for 3 or 4 years, maybe 5 years, then obviously you are coming into a situation seeing that what the authorities want to apply compared to what the operational business requires are getting far away from each other. Another topic is like the application of royalty schemes or license schemes all over Europe. Like for countries in Eastern Europe, you see situations that companies are over there acting as a contract manufacturer, but at the same time having to remunerate the use of IP from entities abroad. So these kind of schemes, we all know for quite a while now, are under fire, I would like to say, because authorities in different countries start arguing, look, is that only a contract manufacturer? Do we have to increase the level of remuneration the manufacturers in these different countries should receive by at the same time reducing the amount that is available as a license fee? So there we have quite some discussions. And of course, I can't spare this one out. Relocation of functions. You all know our very famous German rules on that. But given that we have, and we all know that as well, Chapter 9 of the OECD guidelines, we start seeing a trend for discussions and tax audits where we have to talk about relocation of functions and how to evaluate this, taking into account the OECD perspective, taking into account national perspectives. But this is really getting up to speed, these kind of situations. So that is what we are facing in audits all over Europe. For going forward, there's one particular thing I'd like to mention, the use of the OECD guidelines. For example, take again Germany. Germany has introduced into its administrative principles that the OECD guidelines will form the basis for auditors to undertake their audits. So the OECD guidelines are now part, if you will, of the German regulations. That is for the first time. That has never been the case before. We always had our particular administrative guidance, but now we see a trend. And again, that is also for other countries. Austria has a clear history applying the OECD guidelines, but we see more and more countries getting into the OECD guidelines. On the one hand, that is good because we have an overarching and a framework to say so. But on the other hand, we all know the OECD guidelines tend to include compromises between the countries, which is true and which is obviously the case, but it does not make things easier in tax audits if you want to come to a conclusion and if you want to apply the arm's length principle and have different interpretations from different countries which are set forth or got their entrance into the OECD guidelines. With all that, that is what I wanted to put in a nutshell for the EU trends. Michael, what about the UK?
Thanks, Stefan, and thanks for inviting me along as well, David. The UK is interesting at the moment, probably a bit too interesting in some senses, but we are where we are. In terms of the UK, we've traditionally been open for business, is how it's described at the policy level, trying to attract inward investment and welcoming it in, which has always been kind of the high level policy objective we've seen from the Treasury. But that's been paired with quite an interesting on the ground experience for lots of clients coming in, where the audit experience is very intensive and very rigorous. So businesses can feel welcomed in, but then once they're here, they can be treated quite rigorously because they're expected to comply with all their tax obligations around TP. So what this has led to, and I think a lot of clients are seeing this at the moment, is that the approach to transfer pricing issues is very much evidence-based, very much fact-based, and HMRC looking to test substance and look at an awful lot of documentation. That's kind of across most issues. So whether that's contract R&D, whether it's ownership of intangibles, whatever it be, HMRC's approach has become a two-step one, really. So step one is gather all of those facts that underline the business and test them rigorously by looking at documents, by often interviewing key people. And that fact-finding part of the inquiry can take a few years in some cases as well. It can be very intensive. Once phase one is done, it's only then at phase two do you actually get to talk about TP and do you actually start to get to talk about pricing and move towards resolution. So what that's led to is a number of inquiries either taking far too long or getting stuck where even basic agreement on the facts can't be reached. And I think that's been quite frustrating. And the other current thing that's maybe just on the go at the moment is an issue where we have companies that have a large management team, and maybe most of that management team, most of the senior people are not in the UK. They'll be in another location, but we may have one person here in the UK. That's quite a hard thing to price and quite a hard thing for HMRC and businesses to agree on. some businesses may think, well, one person from the management team of 20 in the UK, cost plus may look appropriate. HMRC will often be pushing for some form of profit split, which the businesses can often not be very pleased with either. And the gap in terms of tax between those two methods can be a really, really big difference. So we're seeing a number of inquiries get stuck in that gap at the moment, and we've been talking to policy and working with the inspectors to try and find a way through that we can all kind of agree upon. But we're not there yet, unfortunately. But that is where we're going. And in terms of the future, that's about going forwards. It's going to be more of the same, but much more intense, which is the good news for everybody, I think. Documentation is going to be key, to the extent that HMRC are consulting on quite a few things at the moment around their information powers and around their documentation requirements too. So we're expecting these changes to come in next year, but they're not final yet. But the direction is that HMRC's information powers will be expanding so that the UK company in a group will be required to provide documents that are maybe in the possession of overseas companies in that group. And traditionally, that hasn't been the case. Companies in the UK as well, those big enough over the country by country threshold, will be required to maintain their master file, their local file, and a HMRC created document called a summary audit trail, which explains the processes of how you've reached your TP position and what you've done to get there. Those things will have to be prepared by a group and by a company prior to filing, and HMRC can then ask for it on demand within 30 days. Now, the other development here is that typically HMRC asks for documents during an inquiry. So they open the inquiry or the audit, they start the discussion, then they ask for the information and the documents. Here, they're changing the rules or thinking about changing the rules to allow them to ask for those things without an inquiry. So what that may mean is that many, many more businesses will have to submit these documents. HMRC will have a whole ton of data available and can select the most likely winners, as they would see it, from that pool of potential inquiries. So that's one big change. And the other really big change that's possibly coming as well is that HMRC are looking to change how penalties work just on transfer pricing as well. So in an audit, if there's an inaccuracy and HMRC change the CT return, they have to consider whether a penalty is due. And they can take a penalty if they can prove that the business was careless in preparing the return. Now for TP, that will change, only for TP. It will change to become a presumption of carelessness on the business. So if there's a TP inaccuracy, the business will have to prove that it took enough care in order to escape the penalty. And that's quite a big shift. And it's not even really a reversal. It's a presumption that you didn't take enough care. So the key, again, to go right back to where I started, is documentation. And if you're a company operating in the UK now, you need to document not just your TP, but your processes for your TP, and you need documentary evidence of all the care you've taken. So an awful lot coming up, but it's an interesting time, I think.
Thank you both. And a couple of things jump out at me from your comments, Stephan and Michael, both with respect to the fairness of the process. So Stephan, you mentioned about the new law implementing the DEMPI concepts, even for prior years before they were the law, or before the OECD finished their work. That does seem to put taxpayers in a difficult position because those returns have already been filed, transfer pricing documentation has already been prepared, and it does seem rather unfair to expect a taxpayer to have taken into account for those years concepts which were not yet into existence. That does seem a little concerning. And then similarly, Michael, with what you said with respect to this reversal of the burden of proof, which seems to amount to a presumption that the taxpayer did not take appropriate care, that seems like a very harsh approach too. But I think the overall message that I'm getting is that tax audits will become more intense and that taxpayers do need to put more effort into preparing for these sort of things, especially with respect to documentation. And Michael, what you said too about the HMR seeming to, number one, it seems like they are trying to streamline the audit process and almost not even having the need to issue IDRs, but requiring taxpayers to answer all those questions even before any sort of audit activity has taken place. And also the focus on perhaps an increased use of penalties by the tax authority. And that is something that we have in common with the US, of course. As you know, the IRS has had several documents recently and several public statements where it seems to be the case that they're looking for cases where they can assert penalties when the documentation is not appropriate. So I do think that is a common theme, and that the response does need to be that there needs to be more of a focus, even more than what we've had traditionally, about having strong, robust transfer pricing documentation to support the allocation of profits. Maybe one other follow-up question for the both of you too. So I also wanted to ask about DAC 6 in the EU, and I'm definitely not the subject matter expert in DAC 6, but this is a new reporting regime, and it does have various sort of transactions and other things that have to be reported proactively to the tax authority. And I do know that one of those areas of reporting requirements has to do with transfer pricing, specific hallmarks related to certain transfer pricing issues, things like transfers of hard to value intangibles. And I know DAC 6 has gotten a lot of attention in the past few years. And we've also got, of course, country by country reporting has been around for a few years. And so my question is, are either of those generating a lot of audit activity? Are we seeing the DAC 6 reporting being the impetus for starting audits? And similarly, with respect to CBC reports, is your impression that tax authorities are actually using them, and are they productive for assessing transfer pricing risk? Maybe let me start with you, Stephan, please. Any thoughts on those questions?
David, I do hope you don't expect me to be the subject matter expert on DAC 6. I'm not, but I honestly have a clear picture on what you've been asking for. There is no particular activity to be seen in the market yet. Authorities, and I'm saying that with my view, I don't have figures or evidence around me, obviously, or I've not seen audits that have been triggered from, let's say, the country-by-country reporting or from a particular DAC 6 reporting. But obviously, it is kind of disciplining the taxpayers to think about all of this, and I think that was also one of the aims of the countries to get this in. But in all honesty, I think it will take a couple of more years to come in order to get through the country-by-country reporting, for example, to trigger audit activity. Whether it takes a couple of years, I'm not so sure, but it will take some time.
And from the UK, David, I did work in HMRC, undertaking these risk assessments and leading this work. And I know the message HMRC wants to put out there is that risk assessment has become incredibly more sophisticated and IT-led in recent years. There is a thirst for data, and there is a tremendous ability to collate it and analyze it using IT. So, the DAC reports, the CBC data goes into the pot with the accounts, with the VAT returns, with the employment tax returns, with the information that's perhaps been shared by the tax authorities, with the information they found online, on the group's website, on the investor pages, the information they found on LinkedIn about the people. All of this is poured in, and then some people who are analysts by profession, not necessarily transfer prices, but professional analysts, will comb all of that for risks and produce a list of potential businesses that look as though they have transfer pricing risk. So it's forming part of an ever-growing, ever more sophisticated picture, I think, for HMRC. And I think when you add in these new documents they're also asking people to produce they will have a lot of information available.
So all very helpful. But if I can turn to litigation now and what we're seeing there, are there any trends that you're currently seeing in the EU, Stephan?
Yeah, I think the overall argument is we see a clear trend to litigation. And I think there are a couple of reasons. Let me first say, I think there, particularly in Eastern European countries, we see a clear trend to litigation, but we also see it, for example, in Germany, where we have been somewhat reluctant in the last years to start this. But let me focus on two reasons. I think most importantly, if you look at all the countries all over the place in Europe, most of them have introduced either transfer pricing law or regulations or administrative guidance. So we have a level, or we have reached a level law and regulations available in the last 2 decades, that the interpretation of the law now needs actually litigation, because most of these problems you won't be solving in a map. And that leads me to the second point I'd like to focus on is, and I'm saying that with all respect for the competent authorities, but if you look at maps as an instrument to solve controversy issues, to get into the cases, to get legal certainty in a way, then you see really numerous cases where you're disappointed about the result, because that is all driven through long processes. And I can say that as being German, we are now leading the field. We have the most open cases in map cases. If you look at the OECD guidelines, that is, you see how long this process may take. And again, I'm saying that with all respect for the CAs, it's not an easy one for them. And at the same time, you get unclear results of the maps, because at the end, once you get a result, you cannot be sure, okay, now I know how my transfer pricing system needs to be taken care of or how it should be handled, because at the end, you get a result, but you won't know where it's coming from, what is the particular outline of this. So these 2 reasons, for example, I would say, are really showing that we have a clear trend to litigation, and this will take much more speed in the next years, I'm pretty sure. Michael, what about the UK?
Very similar picture, Stephan. Clear trend towards litigation here as well. For a long time, HMRC were reluctant to litigate on transfer pricing, but that is changing now. They've had a very recent win at the tribunal with a case which has boosted confidence there and raised morale. And the mood music coming out pretty clearly from the HMRC teams is that there is more litigation to come. Obviously, we don't know who that is or what's in that pipeline, but we do get the sense that there is one. And that ties with what we see on the ground, where the inspectors in the audits are raising the prospect of litigation much more quickly and with much more confidence, and offering, to say to clients and to businesses, if you don't like this, we're very happy to go to the tribunal, which again was something they were very reluctant to say for a long time. So there is a definite shift on the ground, and I think we'll see more TP litigation for sure.
Excellent. And given that environment, so I think it makes sense to turn next to APAs, or advanced pricing agreements, because of course, if we've got an environment that's very turbulent, a lot of potential controversy, and we'd like to avoid that and get certainty sooner, well, a bilateral APA is the best way to do that, right? A bilateral APA or BAPA is the gold standard in getting certainty and avoiding the time, cost, and expense of having a dispute further down the road. And in that regard, I note recently that the OECD issued another important document here, actually issued by the Forum on Tax Administration, or FTA, within the OECD. They released a document called their Bilateral Advanced Pricing Arrangement Manual. And I'd like to ask if you see that having any impact in the near term or perhaps further out. And also, what about the current global policy environment? How is that impacting dispute resolution? Michael, why don't you start, please?
Thanks, David. So on the bilateral APA manual, or the BAPAM, as it's not very catchily being called sometimes, that is outlining best practice in bilateral APAs, and it's very welcome as a resource for tax authorities and for taxpayers to put some clarity in, and to try to set some sort of best practice standards. So there's an awful lot of positive recommendations in there, trying to increase transparency, increase cooperation, make better use of technology, all with the idea of emphasizing the advanced part, which is often lagging somewhat in our APAs. The stated intention in the BAPAM is to get bilateral APAs finalized within 24 to 30 months of the application going in, which I think for most countries would be a step up, I think. HMRC's had a lot of input into this manual. They fully support it without any sort of reservation, and I think they endorse everything in there. That said, I still think it's going to take some time for these recommendations to filter through into practice, because you can't change these things overnight. You can't turn an oil tanker around very quickly. So it's welcome, absolutely welcome. And I hope long term it will do something, medium term perhaps, but short term, I'm not seeing any immediate change on the ground just yet, particularly because it's not actually a binding document on any tax authority. So it does still leave that question hanging, I think, of what do you do as a taxpayer if your APA is taking too long? How do you escalate that? How do you try and push that along? You can refer to this document, but it's not actually binding on any tax authority. So I think it's more of a culture shift than an enforcement measure, I think. Stephan, I don't know what your view is, but that's kind of how it looks from the UK.
Well, first of all, I couldn't agree more on the manual. I think it's a very good approach. It will be helpful, but I think I'm fully with you. For the time being, it's not legally binding, which I do understand it would be an issue to get this legally binding. Obviously, would have to take it in the double tax treaties or whatever. But I think it's helpful at least to have a certain framework where authorities see, okay, that is what the OECD and all the member states think is the right approach. And when the CAs should be start thinking about, okay, is it correct then that we now negotiate for 4 years, although we should be done in 24 months? So I think that will have a positive impact, but for the time being, it does not happen. Maybe that's asking too much that it should get into effect right away. But again, I'm quite positive about it. Let me also share some insights or experiences on the APAs. David, you've mentioned that is the gold standard, and it's still the gold standard in order to achieve legal certainty. But at the same time, at least there are a couple of situations, I don't want to talk about trends, but situations which you should be aware of. Let me start focusing on Germany. We do see situations very recently that the German CA, together with the German Federal Ministry of Finance, starts rejecting APAs, but not for the transaction under being subject to the APA, but from a broader policy perspective. And that is, if countries are involved where the authorities in Germany think that, on the other hand, they may see aggressive tax planning, they start seeing ground then to reject an APA, which I totally reject this point of perspective because there is no legal basis for that. And I'm pretty sure we'll have a tough discussion with the authorities in Germany, because if they want to reject something, then they need a reason. Yeah, and I do see that as a kind of broader policy thing, which they may take into account. But we're talking about clear transactions, and if the taxpayer has applied for it and has provided whatever he was asked to provide, I don't see how in this case, the German authorities could have a ground to reject it. Other situations that, for example, goes with the UK, we see particularly complex issues like, again, the relocation of function topic, where we see negotiations between the countries in an APA, which I think makes perfect sense if we have complex issues to get this into an APA. But we do see very tough negotiations, and we have seen cases where they have stopped negotiating about that because German authorities then said, okay, that is too complex. We will wait for the tax audit to deal with that. Then obviously the APA goes away. I want to give some good examples. We do see, for example, have an APA running for between China and Germany, and that is still a very rare thing. And I do see that both authorities, although the formal procedures are very incongruent, try to do everything to get this running. And we see in other countries like Eastern Europe a trend that the authorities are willing to negotiate the APAs, but you see very different approaches, very different formal procedures. And I think that is something, and I do hope that the APA manual, just to close the cycle, that the APA manual will help to develop a common understanding between the different countries in Europe, in the best of the world from a global perspective, but that we get a certain formal procedure behind it and a formal process behind it, that would be helpful.
Very helpful comments. And maybe just a follow-up comment along the earlier theme that sometimes we're seeing a lot of similar trends across countries. And Stephan, with respect to what you said about Germany being more selective about the cases they'll accept into the APA program, and also potentially withdrawing from negotiations at some point, we've also seen in the US, the IRS has said that they perhaps will be more selective in the cases they will accept into the APA program going forward. We don't have any indication of what those criteria might be for limiting the APAs that they will accept. And also, we've got word that the revenue procedure setting out the APA procedures will be revised. There is concern, too, that one of those revisions might include a provision that would make it easier for APMA to revoke an existing APA in certain circumstances. And of course, a few years ago, there was a significant increase in the user fee to access the APA program. All of those sort of factors, I think, potentially could lead to less access to the APA program, which I don't think would be a good development, given that APAs are difficult, time-consuming to do, but they really are the best alternative in terms of avoiding disputes further on down the road. But next, I'd like to turn to the OECD's so-called BEPS 2.0 project and Pillars 1 and 2 specifically. And of course, we highlighted in a prior episode the potential for double taxation and controversy arising from Pillar 2. But I wanted to hear from both of you on what discussions you're having with clients. Let's start with you, Stephan, please.
I think if I think about the discussions we have with our clients, actually, these discussions are very much driven these days for clients to start collecting the data. And actually, they do see that they have their IT landscape and that they try to figure out everything. But for the time being, for the clients, the most important thing is how to organize all of this, because they are fearing they do not have all the information they need in order to cope with, particularly Pillar 2. So that is driving very much our discussions. Obviously, everybody is aware this will have an impact. And David, you've already mentioned you have been discussing this before. They are all aware, all clients are aware this will have an impact. If you look at the rules, and I think we can only say we do see the rules, but we don't have the final set of rules. We will have tough discussions on that. We will have controversy issues. But again, for the time being, clients and companies are very much focused on getting this running, getting data in order to get Pillar 2 particularly running. That's from my perspective. Michael, what about the UK?
So again, Stephan, some very similar concerns here as well. We're lucky enough to have some really good operational transfer pricing people who can help with systems and information, but the discussions are underpinned and made more difficult by the uncertainty, I think, that exists around all of this. Is full adoption of Pillar 1 and Pillar 2 likely? I think there's some skepticism around that. So how does a business prepare when it isn't exactly sure what it's preparing for? So they are gathering the data and they are trying to get ready. There's not absolute clarity on what they're trying to get ready for, which given that the theme of all of BEPS was to try to bring certainty, it's a bit frustrating for some clients. And even those measures that we think may come in, there's still some uncertainty inherent in there. So for instance, there's room for uncertainty, I think, if you get an audit post filing your Pillar 2 position, you could still potentially have double taxation as an outcome in there. And there's no resolution model, I think, in sight at the moment for that. So the discussions are tricky, and they do have to get down into some sort of depth of the business specifics as to how they're going to get ready. But as a general rule, what we're trying to advise is and this is so easy to say and so hard to do, I appreciate, but try and get your transfer pricing as right as possible, because that will minimize the risk of audits, that will minimize the risk of double taxation, and it lays the most solid foundation you can lay, I think, for going forward with whatever comes out of these discussions. And also your point, Stephan, exactly, of keeping the data and organizing the data is an ever increasing challenge as well.
Excellent. And before we end the podcast, can we bring this all home, and can you give our listeners your key takeaways? Michael, let's start with you, please.
So my key takeaway goes right back to where I began, David, with documentation. It's the thing to think about in the UK at the moment, particularly if these proposed rule changes come in as we're expecting. It will be all about evidence, and I mean contemporaneous documentary evidence, not just of your TP position, but of all the thinking that went into the TP position before you filed it. If you have an audit here and it takes, say, 3 years, at the end of the audit, HMRC has to decide whether or not to take a penalty. and will have to make a decision on whether or not you took care before filing the return. And the onus will be on the business to show they did take care. Now, any business that hasn't thought about that and has left it until 3 or 4 years after the fact is going to really struggle. And those penalties could be up to 30% of the tax that becomes due for carelessness. So it's quite significant potentially. So I think what the key message would be is start collecting the documents now, start preserving and organising the documents now. And if you are coming to invest in the UK, then that's fantastic. But it's not enough to come along with a master file and a local file and think job done. I'm all protected for TP, because it's a lot more difficult than that now. Stephan, I don't know how things look over in the EU and in Germany.
Well, I start with saying the obvious. I think given all the budget restraints we have seen in the European countries for a number of reasons, the number of tax audits will increase. The number of transfer pricing tax audits will increase even further. It will become more and more difficult to take care of this because authorities will be much more aggressive, I'm pretty sure. And I think they are already more aggressive. And the other thing is, and I think that goes back to what you have mentioned, Michael, I think the one thing we're seeing is that tax authorities start collecting greater amounts of data from businesses. You have mentioned it before, taking from CBCR, taking from other sources. So that is what they're doing. Maybe they're not yet there to, let's say, get that fully on the road and take the best usage of the data, but they will. And if I look at the German authorities again, but a couple of others as well, I know for the Dutch authorities that they start looking into the email chains and messenger services in order to review who is doing what. And that goes again back to trying to identify DEMPI relevant functions. And they try to find out, okay, who has taken care of what has been set forth in the documentation. Is that really the guy sitting in Germany or the Netherlands or UK or in France? Is that really the person? Was he or she involved in getting things done and taking decisions and being capable of taking these kind of decisions? So they really want to get this kind of evidence. So the one thing is authorities are trying to do that, collecting more and more data, and they try to find out what is behind all the data. So, and I think that will be the things we will have to take care of in the next years.
Very good. I want to thank you, Stephan and Michael, for joining me today and for that very insightful discussion. I also want to thank our listeners for joining us again. We'll be back next month with our next episode. Until then, thanks for listening and have a great day.
This podcast is brought to you by PwC, all rights reserved. PwC refers to the U.S. member firm or one of its subsidiaries or affiliates and may sometimes refer to the PwC network. Each member firm is a separate legal entity. Please see www.pwc.com/structure for further details. This podcast is for general information purposes only and should not be used as a substitute for consultation with professional advisors.